The street cheers a strong quarter from HCL Tech. The stock is higher by about 2.5% on margins, beating estimates, while the street is also positively surprised by them raising their FY23 revenue guidance.
Wipro second quarter numbers meet estimates. However, the stock tanks on modest revenue guidance for the upcoming quarter.
Aluminum stocks in focus as prices spike after reports suggest that the United States is considering a ban on Russian aluminum in response to the conflict in Ukraine. Remember, Russia's Rusal accounts for 6% of global aluminum supply.
Crude slips to $92 per barrel as OPEC cuts its demand forecast. ONGC slips 2.5%.
Spark trades higher ahead of a conference call scheduled for later today, where the company will provide updates on the progress of clinical timelines and its R&D pipeline.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always is Manglam Malu. Well, Manglam, the markets are interestingly priced, right? From where we've been bouncing the last couple of days is around that 16,950 odd mark. Now we're at the low point of the day. Risk reward, at least going by the evidence that we have in the past few days, has been you buy around the 16,950 to around 17,000 odd. You're getting a bit of a bounce. The problem today, I think, is the Nifty bank. After a while, that's shown a relative underperformance. It's down close to around 400 points as we speak. So keep an eye out on the Nifty bank. That needs to bounce as well. Remember, that one as well is very, very close to its support zone. Earlier this week, it went to around 38,500, 38,600. And from there, we saw a bit of a bounce. So both the Nifty and the Nifty bank at very, very crucial levels. The Nifty bank, that's the one that needs to support it for the bulls. Interesting
is the word that you put, Nigel, and that's perhaps the apt word to describe the way the market is right now as well, because thrice in the last 3 times we've approached that 200-day moving average. We bounced back from that. Can we get 4 times lucky? We've seen a fair amount of put writing as well. And if we don't see support at lower levels, then those put writers will have to unwind their positions. So there could be a case for further downside as well. So let's see where we go from here. But we do have with us Sachidanand Uttekar for a quick check on the market. Sachi, where do you think we go from here? Because now we're closer to support zones. Would it make sense to buy, or you would wait for confirmation of a bounce from lower levels?
Good morning, Mangalam, Nigel. Clearly, the way we are looking at it, we are seeing the observation of an inside bar formation. Now, this particular sequence of yesterday, and look at today's data, 17,140 looks like a resistance. On the lower side, 16,960 is probable support. So probably when it comes to Nifty, we may see it oscillate within this particular range itself. And 17,000 on a closing basis may not be breached. But if you look at Bank Nifty, I think the expiry pain is placed somewhere close to 38,500. So we are of the opinion that, if you look at both the indices, it is better to create some short positions even at this juncture in Bank Nifty. We are expecting this particular move that has commenced an hour back to move towards 38,450 eventually. So fresh shorts should be added in Bank Nifty. Stop loss should be placed at 38,930. And on the lower side, 38,400, 450 would be an ideal level to cover your profits.
Okay, all right. And so you're sounding a little bit, to the negative bias, both on the Nifty and the Nifty bank. Shorting the Nifty bank is what you're recommending. But Sachi, what about individual stocks? What are you looking at?
Well, Nigel, I think defensives are doing well. And if you look at the data of Dr. Reddy's, after a sequence of fall, we saw a bullish hammer formation in yesterday's trading session. The confirmation of the same has been set in today's session. So probably we may see it recovering back to its 200-day exponential moving average, whereas it is placed at around 43.40. So we have advised our clients to build some long positions here. The stop loss for the trade should be placed at 42.30, and all the declines should be bought for a target of 43.40. And on the short side, we are seeing some bouts of distribution when it comes to Indian Hotel. After 16 weeks of an up move, this is the first time wherein its 5-week exponential moving average has been breached. If you look at the weekly RSI, there is a negative crossover already established. And even if you look at the daily structure, we have seen a confident negative crossover on its averages 5 and 20. So the data is supporting the fact that we may see this particular slide getting extended towards 300, 305 levels. So positional short idea on Indian Hotels, the stop loss should be placed at around 328.
Oh, interesting. Positional short idea on Indian Hotels. The stock is under pressure after having seen a big rally. So we'll keep an eye out on that one. Sachi, thanks a lot for joining in. take a short break. On the other side, we will be back with the management of Ethos Watches. They will detail to us, how the sentiment during the festive season has been. Welcome back. As promised, let's get chatting with the management of Ethos Watches. Remember, this is a company that runs a luxury brand, luxury watch store. They have around 17 odd stores, and they have a target of reaching, rather they have 50 stores in 17 cities, and they have a target of adding around 13 stores in the next 3 years as well. We have with us Yashovardhan Sabu, who's the founder and chairman of the company. Thanks a lot, Mr. Sabu, for joining in. Could you tell us, the second quarter is seasonally weak for you guys, but how has that been as compared to the first one? And now, importantly, the third quarter, that is extremely strong. What have the initial footfall trends been like?
Thanks, a pleasure to be here. Actually, the second quarter, which is usually equal or a little bit weaker than the first quarter, has actually been pretty good and pretty similar to the first quarter. So we are very happy with the second quarter results and what we're going to be showing soon as the half year results. And going into the third quarter, obviously the third quarter is the most important quarter for most of retail, and it's no different from us. It's called the festive period, but for us, this is the quarter that really is the best because it coincides with the wedding season. And of course, watches are a very, very important and increasingly popular gift at the time of weddings. So we are anticipating a great quarter. At the end of the Shraddh period, we are already seeing an uptick in sales, and this gradually grows until Diwali and even more after Diwali. So we are ready for a super quarter.
Okay, all right. Hi, Mr. Sabu. It's been a while since we spoke. Nigel, on this side, you're sounding reasonably optimistic, and quarter three, as you said, should be a blockbuster. Deep pockets, I would say. People coming out there and buying those expensive watches. But be that as it may, give us a sense on business. I think online sales accounted for close to around a third of your sales, as per what we have last. What is the mix right now, if you could tell us? And also, what is the margin difference between online and offline?
So online, so I would like to start by saying that we don't make a very big difference between online and offline. So our model is really omni-channel, and that is because the customers are now seamlessly spread across both the channels. Very often, the journey of starting to buy a watch, the research starts on online. Then they visit the store, they physically see the store watches, they evaluate, they think about it, research more online, and finally close the deal at the store or even at their home. So it's not really a big difference, but what we call online is leads that start or sales that are made from leads that start online. Typically, this has been between 33 to 35%. That's where it is right now. During the COVID period, of course, it jumped up to as high as 40%, but it's at about 33 to 35%. There is no margin difference between the two because our terms are exactly the same, whether someone comes, starts the journey online or wherever the sale is consummated. The terms are exactly the same. So there's no margin difference.
Right, we take that point. You said, the demand in the second quarter has been better than anticipated, which was otherwise a seasonally weak quarter for you. You are anticipating an extremely strong third quarter as trends from post-Shraddh indicated. So what does that mean for an overall year revenue perspective for you? Because, at the start of the year, you had a target of 25% growth, then you upped it to 30 to 35 odd percent. Is there a chance that given this optimism, you may outdo that as well?
Well, we're still looking at the same. That's because, it's not a question of a quarter by quarter kind of divergence. I think what our estimate of what we would be growing this year was based very much on a strong undercurrent of demand that we have been seeing developing over the last 2 or 3 years, starting from the pre-COVID period. And we could see glimpses of that in the quarters that were not impacted by COVID, even during the last 2 years. So we are really basing our projections and estimates based on that. We still believe we will be growing by about 30 to 35% over the last year. I think those are nice numbers. Of course, we are looking at the global economy. But I think India is strong. The market is very strong, and we are pretty confident of getting those numbers.
Okay, all right. And give us a sense about your store, number of stores that you've opened, say at the halfway mark. And for the year, what kind of a store opening number are you looking at?
Well, a lot of our store openings actually depend on the malls where they are housed to be ready. Some of them are delayed. We hope to open 8 or 9 stores in this financial year. Many of them are just around the corner. We're starting the fit outs, but most of them will actually come into operation in the last quarter of this year. So they've been delayed because some mall openings have been delayed. Overall, I think we've upped our expansion plan over the next 3 years to expand by about 35 stores. This includes stores in several new cities, 9 or 10 new cities, and also increasing our presence in some of the metros and smaller metro cities.
Okay, all right. So you're saying that 8 to 9 for the year, for the next 3 years, 30 to 35 is what you're talking about. Till today, how many have you all opened? New stores in FY23 so far, and also give us a sense on the average selling price. I think it was at around 1.6 lakh odd.
It's about 1.6 lakhs right now. Since May, we haven't opened any store this year, but we hope to open some, as I said, we hope to open 8 or 9 during the last quarter of the year. The mall, there is an additional store in Bangalore. There are 3 stores in Ahmedabad and 2 stores in Indore. This is something that I can immediately think of. Yes, and Surat, Raipur, these are all on the cards too.
All right, take that point. Just a couple of questions on your other relatively smaller but fast-growing businesses. The pre-owned, you had a target of almost, 75 crores in terms of revenues this year, crossing that 120 crore for the next year mark. What does that number stand at right now? Do you think you can better that this year? And secondly, on your... Go ahead.
So it looks to be on track. I think we are looking at the same numbers, 75 and 120. It is a fast-growing segment. A very, very great response from the market. However, we have to be very cautious in how we grow because selling pre-owned watches with credibility means certifying the watches and making sure that the refurbishment is superb. And this depends on the skills of qualified watchmakers, which we are constantly upgrading. So, yeah, we hope to be able to achieve those numbers.
What is your updated market share, Mr. Sabu, before we let you go?
Sorry, can you say that again?
Updated market share.
Market share, we're not really able to sort of look at it on a monthly basis because estimates of the overall market size actually come in only a bit late. I think we are increasing our market share in the luxury segment. It was 20%. I believe over the next couple of years, it will go to 25% or more, and we're on that track.
And how many exclusive brands have you added this year? What's remaining for this year?
We have been in discussion with several brands. I think we've added 2 brands. And I hope that before the end of the year, we will be able to share the names of at least 2 or 3 other brands that we will add to our portfolio very soon.
All right, take that point. Thanks a lot, Mr. Sabu, for joining in and giving us the outlook. Reasonably optimistic for the second half of this year and this year itself, even though they believe that they will, meet that 35% sort of guidance coming by. The street likes that optimism. The stock at the high point of trade. We take a short break, come back, we get you more on the markets and individual stocks.
Well, the markets are stabilizing around that 17,000 odd mark, but from the broader markets, a couple of stocks have moved lower. Some of those actually have been big gainers. Escorts, Kubota, just pull up the day chart out there. That one has moved to the low point of the day. Indian Hotels, that's been a big gainer in the last year or so. Well, that as well has given up some part of gains today. And the other one is Adani Wilmar as well. It's moved up multiple times, but from today's high, in fact, is under some pressure. Mangalam, we have an operational update coming in there. That's why the stock is under pressure, right?
That is why the stock is under pressure. In fact, the operational update, Nigel, indicates that there are macro challenges which continue to impact the business this time around. And we know the way oil prices have fallen from the top. Edible oil business witnessed a higher volume growth, but it wasn't as translated in the revenue, the overall revenue is still expected to grow at low single digit. Why is that? Because prices of palm and soybean oil are down 40 to 50% from the peak, and the company has had to pass all of that on to the consumers to protect its market share, and as a result of which the margins will also be impacted this quarter, which is why the stock is lower. But the few things that really stand out are the growth vertical of the business, which is the food and FMCG business, on a low base has actually grown 40%. So that is something that's a positive. And secondly, industry essentials, which is a relatively stable business for them with regards to supply to B2B, has also grown 20%. So those are a couple of parts of their portfolio doing well, but the larger chunk still impacted by lower oil prices.
Okay, all right, Mangalam, thanks a lot for that. Well, we'll wrap up on this edition of Chartbusters, but as we do that, let's listen out to our market master of the day, Credit Suisse's Dan Feynman, what he makes of the Indian and the global market scenario. Let's listen.
The problem in the U.S., as everyone knows, the Fed is going to have to be raising rates. We're concerned that markets are still a bit too optimistic about what happens in 2023. I think people are prepared for this year, but we aren't expecting a pivot for the Fed to start cutting rates next year. We think that rates will stay high next year. India, we have some problems. We have a balance of payments challenge. The currency is probably overvalued, but the economy is doing much better than what we will be getting from the US. There is EPS risk, but I'd say less than in the US. PE of India relative to global equities, relative to Asian equities, all-time high. We're in uncharted territory, and that makes our foreign clients feel uncomfortable. The Fed has already made its last hike. You don't want to wait until markets have made their last EPS cuts. You want to get in maybe 6 months in advance of that. So potentially the bottom for the market could come well before the bottom for EPS or the peaking of rates.